Hi, everybody. I'm Avi Anushi, originally from the United States. I've been doing venture lending for about 10 years now. Um, so racked up quite a few deals under my belt, and happy to share some of the basics with you, things that you need to take into account as you move into this world. For whatever reason, venture lending is somewhat taboo, not sort of spoken about in the high-tech circle for some reason. Um, Everybody likes talking about the large VC raises, the sexy multi-million-dollar raises for equity. But venture lending sort of gets a back seat. And I don't know if it's people being ashamed or people not wanting to talk about debt. In other areas of industry, everybody gets debt. Look at all the tycoons that make the news here locally all the time. And that is something that's definitely part of business. On a personal level, probably the closest comparison to what venture lending really a mortgage from a bank to buy your home. So debt is something that's definitely part of our world and something that we should be aware of, and it's definitely not something that we should be afraid, shy, or embarrassed of doing. It's actually a fantastic way to bring value to your company and to expand and grow. So I think the first question really is why should we do venture debt as opposed to what is common, which is an equity raise. So I think four main points to touch on. You talk about valuation. Obviously, in an equity round, you're going to have to figure out what the value is. You're selling off a portion of your company. In venture lending, it's just not relevant. We don't get into that. The lender doesn't care. It's really a minute point, and it allows you to actually postpone that point and potentially bring in a future raise if you need that at a later date at a much higher valuation. A second benefit to debt over equity is the due diligence process is much simpler. Lenders care about whether or not you're going to be able to repay your loan and whether the collateral that they're getting is something of value that they can rely on. In venture lending, the second piece of what the collateral is a little bit less tangible, since most of the time you're a startup, all you have is the idea, the basic IP. There really isn't much. So venture lending is taking this huge risk that you do have something in hand, but there's still no guarantee. So the second big benefit is that we kind of bypass most of the due diligence process. It saves on the manpower of collecting all your documents, presenting it, the hours and hours of lawyers reviewing, accountants reviewing all your documentation, checking everything. It's a much simpler process. And obviously, every lender has its own process and what they want to focus on and what they're going to look at. But particularly on the legal side, legal due diligence is cut down to mostly a minimum. The next piece is repayment. This, to a certain degree, is a downside of lending. Obviously, the money comes with strings attached. In equity, you have a wedding, you bring in a new partner, and they're along for the ride until they exit. In lending, they're only around as long as you owe money. If you can repay the loan, they'll take the lender will take the money and run, and that's fine. On the other hand, your shareholders don't have any way to call money during the lifetime of your venture until you get to the exit event, or if you're fortunate to be one of those companies that can give out a dividend. But during a loan, you will be paying interest payments and principal payments, and we'll get into that a little bit more in detail later. But that's another aspect, a trade-off that you need to take into account. And the last piece is the security or the collateral, and that's what does the lender get? The lender, obviously, if everything goes south, can get their hands on whatever assets you do have. That'll be the collateral. Your shareholders are going to be last in line if the company goes belly up, so they have no protection. The lender can theoretically go and realize whatever assets there are. So those are sort of the trade-offs between debt and equity. I think the main legal ones that you should be aware of. And I think what's most important for a young startup, for those of you in the crowd that are on the startup side, it's a way for you to bridge, to get further along, allow growth without taking on the effects of dilution of a round. And that's a really key part of lending in general. Okay, so the basics of a loan, you need to first think about who the lender is going to be. There are lots of different types of lenders. You have people like Ido who are sort of tied to VC institutions. There's a different mindset. They're a lot more flexible. You have banks, and I'll even separate local banks and foreign banks as, again, different mindset. Banks tend to be regulated much more strictly. They have less flexibility. On the other hand, they've been doing this for a lot longer than any VC fund has been around for. And they understand how to provide a loan. On the same note, the VC style funds can show more flexibility and understanding towards the express needs of a company and can tailor their documents a little bit more finely where it's needed. So that's taking into account who your lender is an important aspect of your relationship. And regardless of who the lender is, the person that you're going to be dealing with is key to any relationship. You need to have a positive working relationship with the people on the other side of the table, whether it's for positive events or even in times of trouble, to make sure that you'll have somebody who's going to see you through the good and the bad and will have your back. So the relationship with your lender is critical, and it's important to understand who you're working with. The next important thing to take note of is the structure of the loan. From a legal perspective, the company is going to take the loan. And depending on how your company is structured, you may have a subsidiary or multiple subsidiaries. Your business may be structured that you have subsidiaries which are distributors. You may have a holding company where all of your IP is located. Depending on the exact structure of your own company and the financial needs where the funds actually need to flow, this may impact how to best set up the loan from your perspective. Which entities are the borrowers, whether there will be guarantors, whether there will be co-borrowers. And then after you've figured out what the best package from a financial perspective from the finance side, you also need to go and check from a tax perspective whether there'll be any implications to this structure. Obviously, you have to figure out whether there are exemptions for withholding tax to the specific lenders, which entity will be making repayments, whether there are local or foreign laws that may impact the structure. This is something that you obviously need to talk to your accountants or to Stefan to help figure out what is the best structure for you. Once you've gotten through these first two steps, the next thing is going to be hopefully getting term sheets, shopping your term sheets, and getting to the deal documents. The deal itself will have multiple documents. The main one is obviously the loan agreement itself. And this will be paired with the security documents, pledge agreements, or debentures, or charge agreements. There's lots of different names, but basically they all say the same thing. They give the lender a pledge over your assets. That would be the collateral. Most of these deals are structured that the asset is the IP owned by the company. Depending on the exact field of business, there might be other assets. If you have a account receivables loan, the asset may be the receivables from your customers. But essentially, the lender will have their hands on everything. And that will be all documented in the security agreement. The third main document is the warrant, essentially an option to potentially benefit an upside. We'll touch on that later. The guarantee may be needed if the structure requires a guarantor, which would potentially be one of the subsidiaries. Perfection certificates are a fancy way of saying disclosure schedule, but as I mentioned earlier, due diligence is usually a much more streamlined process, and these will basically be statements of fact about the company. Here is a list of our IP. Here is a list of the jurisdictions where we're registered to do business, things of that nature. And the final piece will be actually registering the security, and there'll be various government documents that you may have to file depending on where you're located. Okay, so once we've got our deal documents, So we're going to be looking at two different kinds of loans primarily, either a term loan, which is as similar as possible, I guess, to a standard mortgage that you might be familiar if you bought a home already. And the second type is a revolving line of credit, which usually breaks down into two different categories, either an accounts receivables loan, backed loan, or a MRR or ARR backed loan. I won't get into the fine details of each of these, and maybe that'll be something that Ido touches upon in his section. But the difference between these loans is a term loan, you usually get a lump sum up front, and you then repay over the period of the term. The account receivables and MRR are backed against certain receivables that are incoming and discounted. A credit line which you can draw against on a monthly basis or on a quarterly basis, which allows you to constantly redraw the loan amount at any given. Other important details to be aware of: the size of the loan, the minimum drawdowns, which would potentially give you flexibility as to how much money you can pull at one period of time, the interest rate, which may shift or be a fixed rate, the payment schedule. Here it's important to note that some lenders are willing to give an initial grace period with interest only, followed by interest and principal payment. And this is something you should definitely be aware of when you're negotiating your terms. And then obviously there are all the fees, some more apparent, some hidden. And you'll need to take a look, compare apples to apples, which is not always easy. Chronology may change depending on which lenders you are talking to. Okay, so we started to talk about collateral before. I spoke about the security agreements. So the collateral will usually be structured as a fixed and floating charge over the assets. These will obviously need to be registered locally. Here in Israel, the registration would be done with Rasham HaChavarot, if you're a company, potentially with Rasham HaMashkonot, and you would also have Rashamim, other Rashamim, depending on what the actual asset is. For instance, if you have patents, you'd have to register with Rasham HaPatentim as well. This is a relatively technical process, but it's one that you need to be aware of, as registration is obviously an important piece of perfecting the security interest for the lender, and is usually a condition that needs to be met before they will wire any money to you. Okay, the loan agreements themselves will typically have what's called covenants. These are the do's and don'ts that will guide you during the term of the loan, and you'll be subject to this the entire time. The compliance with these is critical because failure to comply will result in a default. The do's are things such as providing various information rights, whether it's monthly financial reports, audited annual reports, other inspection rights. There's usually a requirement that you maintain minimum insurance coverage, and depending on the lender and the terms of your loan, you may also have financial covenants, requirement to meet certain quarterly MRR, or maintain a certain minimum balance in your bank account, things like that. The don'ts usually are very similar to what you'd find in the veto rights that your investors insist upon. And these are all things that you cannot do without getting the prior consent of your lender. Things like a change of control, changing your business, transferring or selling any of your assets, and incurring other indebtedness. All right, so the next important piece is, what is a default? When are you in trouble, and when is the lender going to call immediate repayment of the outstanding loan amount? Usually there's a laundry list here as well of big no-nos, where if you've crossed the line here, the lender has the right to call the loan. And this ties back again to the relationship with the lender. Not every lender will call their loan immediately. There is, an importance to saving face in the market and working with companies to make sure that they can make it through the hard times. And I personally have witnessed numerous different lenders work with companies that have been in obvious default to make it through and come out the other end, and there was no harm done. But this is obviously something you need to be aware of, and as a lawyer, I'm always worrisome when I see these long lists without any qualifications. So it's definitely something to be aware of, and again, the interpersonal interaction with your lender is critical in these sections. The warrant coverage is sort of the candy, the icing on top to kind of entice your lender to do the deal. The lender usually will take a small option to receive equity in the company. It's usually calculated as a percentage of the total loan amount that they're providing. And the exact terms of this warrant or option are negotiated. Typically what you'll see is either a warrant for the current preferred stock or next round stock. American banks have a tendency to actually request ordinary or common stock, but obviously this is all subject to negotiation and something that you should be aware of as well. And the last point that I'd like to touch on, going back to who your lender is, when your lender is a bank, it will not be uncommon to see that a basic requirement that they will make is that you need to do all your banking with them. This may have added costs for you if this means switching over your bank accounts, updating your clients where they need to transfer money. It also may have other hidden costs as to the cost of banking services that they may charge, so you need to be aware of that, something to certainly take into account. On the other hand, if your lender is not a bank, one of the things that they're going to ask for is an account control agreement, which in the event of default will allow them to have access to the bank account. And this is just an extra piece of paper which is going to have to be negotiated with whoever your bank is, which may or may not have been part of this transaction. And so that's another wrinkle in the process that you need to be aware of that may slow things down or complicate things. But those are the highlights. So, thank you. And that covers what I have for the legal basics.
Toda rabba, Avi. Thank you very much. I always wanted to be a news reporter, so I'll start the same way they do. I'll be back to Hebrew for this part. הדובר הבא שלנו הוא עידו ויגדור, האמת שהוא שותף בקרן ויולה קרדיט, והוא אחד מהאנשים הראשונים שאנחנו פונים אליו כשלקוח שלנו מתעניין בתחום הזה של venture lending. הוא יספר לנו קצת מה מעניין את ויולה, ובכלל מה מעניין בתחום הזה, יתרונות, חסרונות, וכמה טיפים של מי שבפועל עוסק בתחום הזה. אז עידו, מעביר את הבמה אליך.
מעולה אלי, תודה רבה. אני... רגע אחד. יופי, אפשר לראות את המצגת?
רואים מצוין.
יופי, מעולה. So I think, shall I do it in English as well?
Whichever you prefer.
אוקיי. אז בוא נעשה את זה בעברית, אם כמובן צורך אפשר גם באנגלית. אז א', נעים מאוד. אני אשמח לדבר איתכם קצת בעצם על ה-investors perspective, זאת אומרת, מה אנחנו מחפשים כשאנחנו מסתכלים על חברות ובאים להשקיע על דרך של חוב. למי שלא מכיר, קצת כמה מילים עלינו, אני אישית, עידו ויגדור, אחד מהשותפים המנהלים בקרן ויולה קרדיט, זרוע חוב של קבוצת ויולה, נמצא כ8 שנים בקרן. ויולה קרדיט בעצם זו קרן חוב פרטית שמתמחה בחברות טכנולוגיה, אחד מהגופים המובילים בישראל בתחום ה-venture lending, הגוף הישראלי היחידי שמתמחה בתחום כקרן פרטית, קיימים מעל 20 שנה, הרבה שנים של ניסיון, עם 6 קרנות, מעל $1 מיליארד של הלוואות בתחום ה-venture lending במרוצת השנים, כשבעצם החזון שלנו זה בעצם לספק או לסייע לחברות טכנולוגיה להמשיך ולצמוח. אני אגע בזה קצת יותר לעומק, אנחנו פעילים מאוד בישראל כמובן, אבל גם גלובלית, עם פעילות ענפה גם בארצות הברית, באנגליה וגם באוסטרליה, וכמו שאמרתי, אנחנו חלק בעצם מקבוצת ויולה, שהיא בית ההשקעות הגדול ביותר במדינה לחברות טכנולוגיה.
עידו? עידו, סליחה על ההפרעה, יש בקשה מהקהל אם אתה יכול בכל זאת לעבור לאנגלית.
Yes, of course, sure. So just a few words on Viola Credit. It's the credit arm of the Viola Group. Just for those who, I just spoke in Hebrew, I'll just, in a nutshell, so Viola Credit is a private credit fund, is part of the larger Viola Group, the largest technology investment house that's based out of Israel. We are providing venture lending for over 20 years now, over $1 billion of transactions in the space. So, we've done a lot of historical transactions. And as I said, we're operating globally. So before I dive into the investor's perspective, I do want to just provide some, from our perspective, venture lending in a nutshell, and what does it mean? So basically, venture lending is a type of investment which provides efficient financing for venture-backed companies. So technology companies that are starting at their infancy, they are trying to understand if they're tackling a large market. They're building a solution which is a solution that is trying to disrupt a certain area. There is a lot of things happening, but once they do understand, where they're trying to take the company towards, they're starting with an early stage, probably venture capital firm, providing the first institutional company, and they're starting to build their equity base. Once technology and product market fit is there opens a new arena of financing solution. And the hypothesis behind venture lending is to provide efficient financing to these growing technology companies to extend the cash runway that is needed for multiple reasons, and also to accelerate growth with much less, if not non-dilutive capital. But at the end of the day, venture debt is a secured loan, so it's a loan over the company, which is, as Avi also mentioned, is provided against interest and equity kicker to supplement the return. Typical loans are for 3 to 4 years. Usually durations are 2.5 to 3 years. That means that there is a grace period that is being built into these transactions, and then amortization schedule. The idea behind a venture loan is to tailor the loan to the needs of the company, and that is why it is really important to understand the use case and what we're trying to solve with a loan. Mostly provided to loss-making technology companies that are at their growth stage. So there's always a question, and I'm getting that a lot, is when is the right time, to explore a venture loan? So I would say as following. First of all, there's an important concept to understand that venture debt is not a replacement to equity. It's a supplementary product to equity. It is very important for the companies, even at their early stage, to first build their equity shareholder base. A loan is used for growth, to supplement growth. It is an efficient solution, and for that, you need to build first your equity base. The second point which I would mention is that first the company needs to build their technology and be post-technology risk. There's always risk around technology, and technology is changing all the time. But the point at which you're coming to evaluate if it is the right time, you should be post your technology risk, as well as some product market fit. The idea when taking a loan is for a very specific use case, rather than to continue and build technology or understand where exactly you're trying to head in terms of the market. Venture debt is provided to revenue generating companies. These are, as I said, for the most part, loss-making companies, but there's revenue generating and also repeatable client base. It's very important to understand that there's a repeatable business that is being done for the lender in order to understand or try to evaluate the future projections out there. And I would say that very important is the use case. So it's very important to understand the clear use case of what the venture lending is used for. And what are the milestones that need to be achieved in order for the venture lending to be a successful outcome in this transaction. And I would say also that for very early stage companies, I would say that it's really important that the management understands and has a high degree of the confidence that they are able to meet the milestones that they are putting forward, as that would really depend on the ability of the venture loan to be a successful one rather than a burden on the company. We are obviously evaluating a lot of companies, and one of our roles is also to tell the companies at that point that the venture loan could be, more of a burden rather than help in the growth plans of the companies. I would say from, if you're looking at a venture loan, so I would say that the pure benefits of a venture loan is it really provides incremental cash runway, which is really important for companies that are still trying to put their KPIs in place, that need additional time in order to meet some KPIs, or want to postpone their equity rounds as they know that things are going the right direction, and they prefer not to do the transaction or not to do the next equity round at the moment. So it provides the incremental cash runway. It also, companies that are growing, they're doing good business, and therefore have additional working capital needs. It streamlines that liquidity needs until cash is coming in. It's obviously less dilutive, much less dilutive, to an extent even non-dilutive capital to support growth. So that's highly attractive, both for shareholders as well as, of course, the founders of the companies. But as Avi mentioned, obviously there is a downside to that as well. And for more, I would say, growth stage and mature companies, it's a very attractive and efficient way to fund non-organic growth. So at some point where a company is reaching, or wants to accelerate through inorganic growth, there's good an efficient way to do is through venture lending, and rather than raising additional equity. And I think Avi mentioned that one of the key points is that for a venture lender, when you go through the process, there is no price discovery in terms of valuation. Process is much faster. It streamlines the entire process, as usually we're just focused on the last round valuation for the most part. On the other side, there are things that we need to be aware. I mean, the companies need to be aware of. First of all, is over leveraging. So there are really key elements on how you need to look into what is the right size of the loan that you're taking. There's, just a few tips for that is looking at the size of the loan or the ask relative to the total fundraising of the company and the last round valuation, just to see that you're not over leveraging the company. Also looking at loan repayments versus the, the percentage of the monthly burn, as over leveraging and not meeting the original purpose in terms of the milestone could jeopardize and impact, obviously, future fundraise. So a bit of typical use cases. I would say that the most used use case is additional OPEX to continue and support growth, and do that at minimum dilution. For more mature companies, it could be financing M&A transactions and inorganic growth financing. Working capital needs always grow with, today with technology companies, and AR, MRR lines are highly common in terms of streamlining liquidity. If in the today's world of COVID, cash is king, and companies that are doing equity fundraise are looking to leverage these successful equity raise, and also supplement with some layers of debt to reduce dilution. So that we're seeing a lot as well. And today, with the growing needs of technology companies, there's much more companies that have highly intensive CapEx needs or asset-backed needs. And that's also, a growing area of financing for technology companies. So when we come to evaluate transactions, I'm bringing in some of what we're looking at a high level in terms of what are the investors' perspectives. That's Some of it are more oriented and could differ from, for fund to fund and banks, etc. But that's the key areas that we're looking at. So the first one obviously is, is something that is pretty straightforward, but nevertheless is really important. When a venture lender goes into a company, we do see it as a long-term partnership. It might not be, a wedding, as Avi mentioned, but we do see it as a long-term partnership, and we do understand that providing a loan for 3 to 4 years, and sometimes even more, in the life of a company, which is a startup that's growing, that's obviously, a lifespan that things change, and it's really key to be able to work with the management if the company needs to do some pivots, and there's some so management is really key in the evaluation. For the most part, venture lenders are looking, for a stable equity base of shareholders that are backed by venture capital firms, private equities, corporate VCs, angel investors that are well known, and others. As I mentioned earlier, we do look to evaluate if the company has posed its technology risk, if we're focused on, financing the growth of the company rather than, financing new technologies and others. Same for product market fit. So we want to understand that, where we're financing is growth. We'll do, as part of our due diligence, some client calls to better understand, and evaluate, the perspective of the clients that are working with the companies to ensure that there is a good product market fit in place. Companies, we are looking at companies that are looking at attractive and growing, markets. So that's also a key area that we're looking into. As I said earlier, companies should be at revenue stage. It does not need to be very, and that's a point that comes up a lot. It does not need to be a company that is a very, hyper growth, $10+ million company. It could be a very early stage revenue company, but it does need to be a revenue stage company with repeatable business. And obviously then comes the question around what is exactly the size of the loan relative to the revenue of the company, and recurring business. Recurring business is important to understand that whoever is buying, the product, the service, is using it and is getting value out of it and is coming back to ask for more. So from a use case perspective, we are seeing a lot of companies coming and just needing additional capital, but it's really important to understand what is the use case that we're trying to solve for. That helps us to be highly flexible in terms of the structure that we build together, and that is a key area for management. The ask versus equity raise versus fundamentals. It's important that companies, when they come to request a venture loan, they had an internal discussion and they understand, what is the amount that they truly need in order to succeed in the use case that they're coming to solve for. And it has to be correlated to the fundamentals of the business, to the burn of the business, to the equity that they've raised. If they've raised a small amount of equity and coming for a very large loan, that probably wouldn't work. So that there needs to be some correlation. And we obviously are doing a lot of work with companies to help them understand exactly their needs from a cash flow perspective.
Excuse me, sorry, there's a question from the audience,
Sure.
whether there's a minimum of revenue that you ask for when you provide venture lending.
Yes, good question. So there's no, one number in terms of, what is the minimum, but there needs to be, I would say, the more important is the recurring revenue, that there is someone that is coming back and that the model is working. I would say that we could go as early even as, $1 million of revenue, even that, but we always prefer to go to the to more larger amounts of 2, 3, 4 millions. But I would say that if I just need to put a number, I would say that $1 million would be a minimum, and hopefully there's some recurring element to it. The next point which I wanted to touch is on cash runway. So for a successful venture loan, and when I say successful, it needs to be successful for both parties, we really need to solve for cash runway. So we need to understand together what are the milestones that we're looking to achieve, how long it will, and what are the KPIs, how long would realistically it would take us on a realistic projection. And then we want to ensure that, together with our loan, there's sufficient cash runway to meet these milestones. Otherwise, we're not solving for what both sides are looking for. So and there comes also the next point, which is financial maturity. So for that, for that, you need a financial maturity in the company, around management, sometimes CFOs, to ensure that they understand exactly what they are doing, and they're providing some realistic and achievable projections rather than just putting out numbers. As we do together with the company, some stress testing around these projections in order to ensure that it's a successful ride together. And lastly, I would say that there is always a key and question around fundraising. As I said earlier, a venture loan is provided to a loss-making company that is growing very nicely with a lot of promising things ahead of it, and there's always the additional fundraising need. So we do need to get comfort as investors around the ability of the company to continue grow the business and for the next fundraising to be manageable by the company. So that's the points that I've put forward. Happy to take any questions if there are. Okay, great. Do we have some questions or?
Not at this time. No, I'll just butt in whenever there are. So
I think there's a QA at the end, so we'll have a few minutes for questions. That's what we promised to our guests. Okay, so can we speak about the next speaker?
Sorry, there is a question. Common interest rates. Are there any common interest rates?
Sure, I would say that around the interest rates, it really, it's when we underwrite and evaluate the company, it really is risk-based pricing. So really depends on the maturity of the company. If it's a very early stage company versus a very mature company, there's a bundle of parameters to determine the interest. So there's no one interest rate. There's always the benchmarking between interest and equity kickers. So it really is I would say company specific and deal specific.
Thank you. Just one more question, and then we'll move on to Stefan, and then we can come back to questions. The question is, what percent do you ask for warrants? Range? What about covenants? Lump sum?
Sure. So again, with respect to warrants, equity kickers, and coverages, it really also is a function of as I just mentioned with the interest rates, it's just the same with the warrants. So it's at the end of the day, it's a blended transaction, and depending really on a lot of parameters. And what was the other question?
One moment. Warrants, a range of inside the percentage of warrants. Is there a range? And what about covenants? Do you ask for a lump sum?
Yeah, sure. So covenants. So I would say, and I think Avi mentioned, each venture lender has his risk appetite and tolerance. We're an unregulated entity as a fund, and looking and therefore have more flexibility in terms of how we're building our transactions. And for the most part, if any, we do not take any covenants over the company. So we tend to take more, I would say, a business risk rather than others. But it really depends. Each institution has its risk appetite, and it really changes between one to another.
Thank you.
Okay, can we? Yeah.
Yeah, go for it.
Yeah, so let's do it in English. So our next speaker is well familiar to me. Is Stefan Gubelman, CEO of Gubelman Group. I think that, you know, if you won't fire me after this event, we'll be okay. So he's going to speak a little bit about the relationship that is venture lending. Eventually is still a relationship, just like with any other investor. So this will be Stefan's focus, but he also mentioned a few things from the point of view of the CFO on that matter. Stefan, take it from here.
Hi, everybody. I'm very excited to be. The truth is, this is my first webinar. I'm very used to lecturing, standing in front of people, seeing them, being able to move with my hands. Here, I'm trying to do that. And for my first webinar, I thought maybe I will try to speak directly with no presentation. So we'll try to keep it some kind of personal, although I'm not seeing you, you're only seeing me. Well, I'm Stefan, the CEO of the Guberman Group. The Guberman Group provides services for whatever you will expect from a financial department, meaning from CFO to bookkeeping. We exist for 23 years, and in these years we had something like 1,500 clients or something like that. So we have a lot of experience, and we've seen many things. And some of our clients were taking venture lendings, etc. I would like to add some things to whatever was mentioned before by Avi and Ido, and maybe emphasize things. So I will try and first speak about the actual need and the actual decision to take venture lending or a debt at all. Because yeah, when you raise whatever money you are able to take, this is what is very common in the market. But let's say that you have the decision and you want to make the decision between equity and debt, and it is the same as taking debt in your personal life. Debt is something that you should remember that should be paid back. And debt is dealing with the timeline. When you take a debt, is taking timeline for a future event. And when we're talking about the loan, we're talking about cash flow, usually a future event of cash flow, and using it today. So we are bringing on to today a future event. And when you decide to take a venture lending, you should understand what is this future event that you are bringing to now. And this future event could be, let's say, when you come profitable or cash flow positive, or you believe that you will be able to raise money in the future with a higher valuation, and you need the time to get to that point. But you should make a plan, and like Ido mentioned, your plan or your debt would be a good thing to do only if this plan or this cash flow forecast brings you to the actual point where you want to be, the future point where you will meet your goal and meet this future cash flow. So it's if it is a technological leap that will bring you to a higher valuation or higher sums of money that you can bring. You should make a cash flow for the whole period, including the paybacks of this loan, because again, a loan needs to be paid back, and make sure that you get to the point by the end. A debt is something nowadays that you can take from a venture lender or from a bank. We see more and more cases where banks, commercial banks, give loans to startups. It's something that was almost incredible 10 years ago, but we see it happen today. commercial banks will think like commercial banks, and therefore a loan from a bank is not always something that a startup can take. And when you need a debt and you cannot meet the terms of the bank, then venture lending will be something that you should consider. Venture lending is something that has a cost, and this is the why not reason. The cost would be the price of the loan, and this price is quite complicated and needs to be calculated. We have the interest. I saw that I've seen a question regarding the interest, but a tip I will give you is that this the cost is not only the interest. We have fees, and we have legal fees, and we have warrants and stuff like that. So the real price of the loan or the deal should be calculated, and then this price and the price is using the assets of the organization should be thought as positive and that is something that you should pay for taking the loan and for owning this time that you're trying to own. So venture lending will be something or exists for many years and will be something that should be considered. Venture lending is usually done by organizations that are quite, they think like venture capitalists, and therefore many times, like Ido said, this is something that will be a must. You will not get from some of these organizations any loan if you are not VC backed. And this is something that should be known because we have many clients that are not VC backed, that their problem is getting to the point of being cash flow positive or needing to raise money for development for short term. And if they're not VC backed, it will be very hard to get this loan. Sometimes the collateral could be the reason why this debt could be given by a venture lender. And there are some organizations that all they need is the ability in a future event of not receiving the loan back or not being able to pay, they will use the IP as a collateral, and it's strong enough for them to give the loan. So these are the main things that you will need a strong connection with your VCs and maybe a strong IP to receive this loan. If you can, if this price is something that you're willing to pay and you get into this deal, there are some things that I could mention here. One of them, I think that Ido a little bit talked about, is that, or I will emphasize, it is easier to receive money even from banks and even from venture lenders when you don't actually need it. When you are very close to your limits, you will find that lenders are very suspicious. Therefore, they prefer lending money when you are strong. This is why venture lending should be considered very early before you actually need the money. If you are after a round of finance of venture capital, then you'll be maybe in a good situation to raise a venture lending as extra time that you're gaining after raising money. It's something that is very straight because you don't need the money, so why raise it? And this is a good question. You should understand why you're raising it before you need it. or that you can show the venture lender that the risk is very low, and although you need the money, there is a very high percentage that you will meet the future cash flow, and therefore this money could or should be lended. Since we said that the loan has a cost, and you don't want to pay it if you don't actually need it, and I suggested that you should take it even if you are not sure that you need it, or match before you actually need it. Another possibility is to take the loan not as a loan that is fully taken, but as a credit line. Taking it as a credit line or loans that you have the ability to call for them in the future is something that could actually save cost in interest, since interest is paid only if you take the money, but there is a price for a credit line, and there are fees for building this credit line or this loan that will be taken under some conditions in the future. But in that case, you are going midway. You are taking the loan, meaning buying time or buying a possibility to take the future loan, and doing that when you are powerful, meaning you have cash or you have no need of real need at the moment of the cash. And from the other hand, you're saving money and saving costs for raising this loan. So this is something that could and should be considered. The warrant was not discussed here, but the warrant is part of the cost of the deal, and therefore should be considered as the price of the deal. This price is also an accounting price, so the accounting, the financial reports will show this cost, and the cost is the terms, the good terms of the warrant, or what the lender is beneficiary from this warrant, and it will be part of the company's expenses. It's something that you should know, and again consider as the price of the deal. And another thing that is important to know is when, like I said, it's a loan, and when you have a loan, you have interest, and when you have interest, you have withholding tax. So if the loan is from an Israeli organization or a lender, there usually is no problem, and the withholding tax exams are fully given. There's no problem. But if you are taking the loan from a foreigner, and some of the lenders are companies that are actually doing business from an offshore country, and an offshore country usually don't have tax treaties with Israel. Therefore, when paying the interest, there could be a withholding tax, and the withholding tax should be part of the deal. Who is paying the withholding tax? Is the interest paid before withholding tax or after withholding tax? Because if you paid a net amount, meaning that you will pay the taxes, then you usually will have a 25% extra cost for the deal, and this is something that should be considered again when dealing with a foreign lender. We talked about relationship, and this relationship could mean reports that the lender will require, and maybe these reports are reports that we are not doing today. So maybe there is an extra financial work. Of course, we as a financial provider, as service providers, are usually happy to provide more reports. But again, this is something that should be considered. You need extra manpower in your financial department and more cost of financial reporting. And regarding relationship, I think it is very important to remember that we are talking about investors. I think that Ido mentioned that, and it was in his first page, that this is an investment. From their side, this is an investment, and not actually we or the company sees it as a lender. And usually we are used to consider lenders as not involved. But this is not a common lender like a bank. This is something between an investor and a lender. And sometimes, or in hard cases, when you are having problems paying back the debt or don't meet your timetables and need extra time, we said that you are gaining time when taking the loan. Then the relationship come into being very real. You're negotiating, you are explaining, you are dealing, and in such cases, it is very important that you should due diligence the lender. Of course, if you have the ability to do so, and you have a lot of options to take the loan from, it is important that you will ask other startups or other companies that took the loan from this lender, and ask them do some due diligence. How was the deal? How was the relationship? And again, make sure that you have good vibes with the lender, because you will have some kind of relationship for a few years. So this is my tips. I hope it helped. And if you have any questions, I'm here. Any questions?
Okay, thank you, Stefan. I think we'll move it now to Noah Meyer, who will assist us with the QA part. If there are any other questions, Noah.
No, I don't see any questions. You're most welcome to ask questions later by email if you have. At this stage, there is one question. Will it be possible to get the presentations by mail? We'll check that with the presenters, and if so, we will definitely send it to the attendees. Thank you all. Thank you, Avi, Ido, Stefan. Thank you, Eli, for guiding us so well throughout the presentation. Thank you, audience. And please be in touch with any of the speakers should you have any more questions. Thank you, and bye-bye.
Thank you, everyone. Bye-bye.